is June 24th, 2018, and this is the Q&A session for the weekend. I have about a dozen questions to go through here. So let's just jump right in. The first question is concerning gap openings when swing trading with end of day only. Do I think an entry without a gap opening is a better entry? And the answer for me is yes, and here's why. This has to do with my theory of swing trading. So let's say that we had, that should be a pen, sorry. And the pen color should be blue. All right, man, it's not just giving me a pen, just a minute. Sorry, just a minute. Trying to get the pen to work here. For some reason it's giving me grief. Sharing. Just a moment. I have to share the video with you. Sorry about that. All right. Okay, here we go. Sorry about that. So let's suppose that we had some kind of price action. It went up and then it pulled back and then terminated in a little doji. And let's say that triggered for us a pattern where we were going to say, we were going to mechanically frame it. We would say, reward to the top of the swing high. If it violated below this little hook in the bottom of the doji, we would say, well, there's more coming this way. But if it rebounds from here, we think that this price target in a series of, let's just call it 5 days for a swing, we might think that a move like this would not be abnormal. That would be a reasonable, rational response. So everything that is required to establish this frame of reference, that it's in a critical state, that it could go down and it could go up with a larger than normal move in a shorter than normal period of time, all of that's already baked into the cake prior to the opening. All right, and it's in the closing price that we got in New York. It ended up in a moment of indecision. So all the news and all the price action is already baked into the cake for this particular frame. And our hypothesis does not require anything else. So if the daily bar looked like this, it opened, it had a high, it had a low, and it had a close. And then from the time that it closed, you're talking about 16 hours of news cycle before the next market, before it opens. It's going to open somewhere over in here. Now, the difference between the close here and the open here is what we call the gap. And in fact, if this is something that trades overnight, on a futures market or it's a currency, there is a continuous set of price signals that get you from the close to the open. But if this is just a regular equity that doesn't have a futures market with it, then anything that happens in this news cycle that could be affecting the price has to wait for the open to be adjudicated. So if there is suddenly a lot of noise and then uncertainty about what that noise means that happens after hours, then there's all of this emotion and analysis and strategizing going on after the market closed and before the market opened. Now, I don't know what the right answer is on any of that news. That news, we're not going to find out what it really means until all of the bulls and bears who are moved to act on the basis of that information have had a chance to act and clear the deck and establish a new, reasonable, fair value. What do I think is a reasonable, fair value? I think it's when volatility narrows down and you have something like sideways quiet channel. That, for me, is a working definition of a new consensus fair value. If you get all of the regression lines inside that area, then it's not only compressed in volatility, but all of these regression lines, the 10, the 30, the 90, and the 270, they all agree about this fair value in this price band that's right in here. Okay, so let's review. When we get the swing signal, this was prior to this 16 hours of afternoon news cycle. If it seems to be significant, then what you'll see is that the opening is going to reflect all of the accumulated end-of-day signals to either buy or sell at the opening. And now somebody has to take the other side of that trade. So if there is a pile of sell orders stacked up from end-of-day traders who all think that that news is negative, then that means there's a lot more sellers than enthusiastic buyers. That means the price is going to go down. It's going to gap way down because somebody has to buy that. Some broker has to buy all those positions, or you have to push the price down until you can find somebody who wants to buy it. So the more orders to sell that are in the book waiting for sell on the open, then the bigger that gap is going to be. And the bigger the gap, we know, the bigger the follow-through. If there's a good, strong correlation between the size of the gap and the size of the follow-through. What do I mean by that? Well, if you take the open and you go find a high and you find a low and then you find the close, this distance here between the open and the close is the actual amount of follow-through from the daily session. That's actually the size of the real body. That is signal. And then this stuff up here in the wick, the tail, is noise. So it's noise, noise, and noise. And what the traders that day agreed on was that the real difference between the open and the close is what the daily session decided was the strength of that signal. Now what we know is that the size of the gap correlates to the size of the range. So the gap, the bigger the gap, the greater the likelihood of a larger than normal range. So if you have a big gap, then the probability of a range stat move just increased. So now let's come back to, we've got our swing signal. I want to say all that just so I can answer the question now. So the swing signal is generated by all of the news and the price action and the trading that left the market in this condition at the close, and that caused us to get a swing signal, ta-da, on the basis of all this information looking backwards. It all integrated into this price action. And from that, we have a hypothesis which says if nothing else changes, then we have a reason to believe we have a large move up or a large move down, both likely in shorter periods of time. And whichever way that thing starts moving, then that's the way that we want to go. But now suddenly something happens, some news event occurs in the after hours that causes a gap. In my view, what that means is that all the bets are off. All of this news, we'll call this news sub-zero, the news at the time of the close, is now updated or even superseded by all this noise that happened in the after hours market. So the way I look at what I really want to see is I want to see an orderly entry. And that if this is the day of the signal, I just draw myself this little range right in here. That's the day range, right? Plus a 5-cent buffer. What I want to see is the price open up inside the range that was being disputed yesterday. I want to see it open inside the range. I would really love to see it open inside the real body. That's the best, whether that was filled or not filled. If it opens inside the real body, then we are within the negotiation between bulls and bears that were going on yesterday. That means there's no real change in the dynamics of supply and demand. And then if this moves out of yesterday's range, then I have some new information that the market is starting to vote in the direction that the hypothesis told us could happen. Now, the hypothesis tells us there's a large probability, or there's a probability of a bigger than normal move in either direction. And so if we get an orderly open and then it takes out yesterday's range, now I have some evidence. This is new information that the swing is starting to occur in that direction. And so we can buy the mechanical entry. We can take the mechanical stop as the execution risk. And we would say, if we bought this long and it starts to go up and then reverses and goes this way, we now have information that the large move is going in the other direction. And that's the direction we want to be in. So this is the actual amount of indecision that's baked into the cake between yesterday's high and low. It's not until we get outside of that yellow zone that we have new directional information. So what I want to see is an orderly move inside yesterday's range, preferably inside yesterday's real body. That means that there was the opposite of overnight news. That means nothing different has happened, and all of the dynamics that were baked into the cake at the close are still in play. So what I will just tell you is, if it gaps outside of yesterday's range, leave it alone, because there was some new news event that occurred that upsets all of the dynamics of this trade frame, which gave us a typical trade pattern that we could use our statistics to calculate probabilities and behavior and follow through in time period and expectations. A large gap, a gap outside of yesterday's range, invalidates that hypothesis, and therefore I leave it alone. Okay? So, to follow up, do I think an entry without a gap opening is a better entry? Yes, I do, for the reasons just explained. Do I prefer orderly entries? Yes, inside yesterday's real body, otherwise inside yesterday's real range, otherwise leave it alone. Is it better to miss one or the other trade because of a tight stop limit order? If it opens outside of yesterday's range, leave it alone. So you can put a stop limit order in that says if it gaps outside of this range, cancel the trade. I think the gap, so that's what I think about the gap. If it gaps outside of yesterday's range, then something else is going on. Our pattern is no longer the most important factor in what's going on. Now, what you may have is a very good intraday trade, but what you don't have is a boring, reliable swing trade. So if you listen to the go listen to the day trading course, what I'll tell you is the larger the gap on a percentage basis or a z-score basis, the better I like it for day trading purposes, because now I have reason to believe that we're more likely to see a large intraday range, and that becomes directional usually. And if I can get that direction right, then I have a really good day trade going on. But that same behavior, in my view, invalidates the swing trade from a conservative risk basis. Okay? Yeah, so that's a summary of that answer. Number 2, concerning exit analysis. I remember one of Chuck LeBeau's observations of exit qualities, but can't remember the details. It was very close to our trade index analysis, but I used some percentage figures to measure the exit quality. What do I know about his methodology, and what's my opinion about how to define good exits? Well, first of all, Chuck's opinion was, his presentation was the basis of the trade index analysis. I believe I took it a little bit further. I extended in a more technical direction. But his belief was that if you could get 30% out of the middle of a trend, so let's call it a triple screen. I just always seem to draw this one. You do this, and it's above its 200-day moving average, and it came below its 20-day moving average and ended in a doji and started to hook up. Then I framed that trade like this. I said, if this fails, then the size of this move, you could see another one of that size, and that becomes leg 2. But if it reverses and goes up, then I believe it can go test this 10-day high, or call it a swing high, call it the hump of the dragon, or the 10-day, the peak of the 10-period regression line. All that's baked into the cake. So if this was the move from here back to the profit target, Chuck would say, if you could get the middle 30%, if you can reliably get 30% of that move, because you're going to give up a little bit of it on the bottom, and if it pulls back, you might give up some of that. If you could reliably get 30% of those kinds of pulses or of those moves, then you can make a living on 30%. And then his idea was that he wanted to increment towards 50% by refining his intermediate stops and his stop management. So that, and this is the essence of the 2R battle drill. That if you have framed this overall trade as something like a 2R potential reward, if it gets all the way up to that hesitation point, that when it gets up there and it starts to collapse, this is the essence of that 2R battle drill, that I want to give back less of this upper third. And then the idea on the entry is if I can reduce the amount of price that I have at risk for the execution. In other words, the closer to my initial stop that I can get, the more of this potential first leg, and then all of the second leg, and then hopefully I get a third leg, then I can start doing better, and on average I may be able to go from 30% towards 50%. Chuck said if you could ever get 50% of those kinds of moves, it would just be amazing. So that's the first part. That's Chuck part 1, if you will. So that's Chuck part 1, is this 30% of a move. So in order to do some analysis, what Chuck wanted to see was that if you had this from the time of the open to the time of the close when you exited, if you called that the T time frame, Chuck liked to go out 2T, and maybe this was your trade and you got out here. He would then go out to this 2T time frame and then try to find what was the best possible price in the 2T time frame, that started from your entry into your exit. And he felt like if you just extended it, if you doubled the time period, then you were reasonably in the same trade, and you were really testing to see whether, let's say if the price went up to here and then came out, then maybe you were getting out too early, or if the high occurred in the 1T time frame, then maybe he would say, well, you're getting out too late because this thing is always or most of the time occurring early, and you're waiting for the far side of the hill, and you're giving back too much of this profit, hoping that it will go up, but it doesn't, so it comes down and hits your exit. So he was looking to see where is that high time frame, or where is that high price occurring, in the T or the 2T time frame. Now, what you'll notice is that if I put a scale of 0 to 100 on this, I always enter at 0 and the maximum is 100. You can see if I exited it at 40, then I'm getting 40%, 40% of the optimal trade. And that's where that relates up to this 30%. Now, what you'll notice is that what it doesn't do is talk about the losing trades or the disaster that your stop protected you against by looking at the lowest low, the minus 100 in the 2T time frame. Because I'm interested not only in what am I capturing, but what am I avoiding. And the other side of that is, if I'm reliably getting out at 40, but then I notice this thing goes all the way down here, and if I'm not doing stop and reverse, I need to know that there's all of this opportunity here to the downside. So when you look at the video on the trade index analysis, what you'll notice is that my technique allows us to go beyond just what am I actually capturing out of the optimal trade, but it gives me some idea of am I getting out too early or too late? What is the when I get out at 40 index points? That tells me I'm missing more than half of the trade to the upside. And if I get out at 40, it says there was still a large move to the downside. I want to know all of those pieces of information so that I can start judging which part of my rules need to be adjusted or examined as a high priority. And you'll notice that all of this has nothing to do with the entry, but everything to do with how we're managing the trade and where we're making the decision to get out, and then whether or not we stop and reverse, or whether we play a re-entry or a continuation or a second position. All of those things that deal with the management of the trade, in my view, are more important than uber precision on the entry. Okay. So the trade index analysis is an important lesson, and that's what we have there. Okay, we're going to get into Jake's questions now. Number 3, general framing and second scoop decisions. How would I decide when to add a second scoop in my favor with no targets in sight within the last 7 or 8 months? And that's the case where you had something like this, it pulled back, and maybe you got in, and you framed that trade, and it worked in your favor, and it didn't fail here at the resistance, but instead it broke out. And then you look all the way back, and all this thing has done is continue to go up and up and up, and now you have to look back over a year to see a new high. Well, there's no resistance overhead, or in the best of all possible worlds, this thing is at a new all-time high. How do I judge what is reasonably available as a profit target? And when do I add a second position? One of the things you can do is you can take a look at the slope of the gain. If this thing were truly parabolic and you say, oh, that's the last gasp of panic buying, quite often that will collapse because there's nobody left to buy. That was the last gasp of hot air pushing that thing higher. And so the steeper up that thing is, the more carefully I want to move my stops to preserve the outrageous good fortune of that exceptional gain. So I look at that as the amount of time and the amount of rise. So that's what slope is, rise over run, how much it's gained over a short period of time. And you can classify that, the slope of that line, and by looking at the slope stat, you can tell how unusual is this gain for that period of time. And so if you put a histogram on its side, you would realize, hey, here's one that was right on the average. So a move of this magnitude in 5 days would not overly concern me that this thing is out of control. It's moving along the objective average gain line. But if this thing had been like 2 sigma, a z-score of 2, of exceptional gains, then the fact that it is so abnormal, that might cause me to want to preserve or protect that. And I would be maybe more careful about putting a second position on because of the increased probability of a sharp reversal when everybody now suddenly shifts from getting on board the runaway freight train to protecting their outrageous profits on the way down. That's not the time that I want to get a second position on. I want to make sure that I am protecting and preserving the first profits I have, and then carefully adding a second position, maybe with market's money. So when could I do that? Not sooner than 2R in hand with momentum, but not later than 6R in hand with momentum. Because at 6R, well, let me put it this way, at 2R, the story looks something like this. This was the first R that I risked. Okay, so I got in here, and then it went up 2R, and then kept going. If I put a second position on a 2R, and now suddenly this thing moves 1R against me, I now have lost an R on my first position and an R on my second position, and now I'm back to 0. So just by using the same initial risk for execution, I get 2R in hand, which for me is an unusually good win. And then I put a second position on, and it moves a full R against me, but I've got 2 scoops on. I just let a way above average win become a scratch trade. That really hurts my feelings and makes it hard for me to maintain my sense of calm. So not sooner than 2R. Because if I was only 1R and put the second one on, and then let it come back a full R, I'd let a 1R win turn into a minus 1R win. And that would hurt my feelings even more. Now let's see what happens at 6R. At 6R, all right, so I bet, there was the one that I bet, and against all odds, this thing went up, let's call it almost like frog boxes, 3, 4, 5, 6. And now I'm holding 6R in hand. Now now it starts to go up again. If I put a second position on, and it moves 1R against me, while I lose 1R in the first position, and I lose 1R in the second position, and now what I keep is this. I keep 4R. I still have a wide, and I haven't taken on any more risk per share than I did the first time. And I went from 6R gross to 4R net. I got to keep 2/3 of my excellent position, and so I don't feel as bad, and I just look at this as letting it, I'm taking 2 pieces of market's money and betting that this thing that's now 6R could really go crazy. The only time that ever happens for me is if I got one of these and it went through that 2R and it really blasted through, and now I'm holding 6R, and I put the second position on, and then it fails sharply, and I just say, oh, okay, you got me. It's quite often that 6R move looks parabolic. So somewhere between 2R and 6R in hand is a nice place to make a money management. Just on the basis of money management, you can look at where you can put that second position. Let's take a look at another one, and now I'm going to do one based on trade structure. So that's simply on the basis of money management. And let's say that I had some kind of, let's see, price had moved up, it came down here, came down here, came down here, came down here, and then gave us this kind of shenanigans, all right? So, and maybe this is a doji. Well, I could say, here's my risk. And it wouldn't surprise me if it got to here, if it got up into here, if it got up into here, and if it got up into here. So let's call one, I'll draw these as circles too. Let's say 3, 4, 5, 6. Oh, look at it. Nicely drawn to scale. So this is one where I might say, I don't want to go right at 2R and add a second position with momentum, because that's right at a resistance level. This is where I'm going to invoke the 2R battle drill. But if it moved up, let's say 10 or 15 cents or a quarter of an ATR, or got well above this noise channel, maybe one sigma above this, whatever the Z plus 1 was, then I might put an automatic second order on here. So now it maybe, in this case, maybe 2.5R, because the next resistance level is here. And all it did was it fell fast from here to here. So there's not a lot of support and resistance right here. This is like the traffic around a city in Germany, and this is like the Autobahn. So what this tells me is that price around in here is more likely to suffer and fail. But once it breaks out of here, then I'm entitled to not be surprised if it really rockets up to the next resistance. So maybe I put my second position here at like 2.5R, and then if it gets through here, then my job is to quickly move my stop to no lose plus dinner for 2, and then prepare for the next 2R battle drill, in this case 6R battle drill, in case price gets all the way up here. And then I might also say, let me put a third entry here that's outside of this noise channel, and maybe that's where my third position is, and maybe that's where my fourth position is. And you can see in each case the gains are paying for that next position using market's money. And then if I always am just using that initial 1R cost, you can see that I'm always going to keep something like 2/3 to 3/4 of the maximum favorable excursion on big wins. That feels really good. Okay. This one here, at hesitation but no P1. This is really in the case of a downside move. So let's take a look at this one. Let's say that it opened here, and you had your little now we'll go intraday. If you had a hybrid frog box on, and this thing failed, and then it made its little move. Let's say that you didn't even get a P1, and then later an owl, but instead it just continued to roll right over, and you maybe got a collapsing dragon. So you had a hesitation, and then it continues to fail. Intraday, I might be very interested in putting another partial position on here. But again, I'm ready to get all out. I'm not going to let it retrace a full 1R. If you put a second position on before you get to 2R in hand, you must be prepared to execute all out much sooner. Otherwise, mathematically, you're going to turn winning trades into losing trades. So my general rule of thumb is 2R in hand plus momentum, and then supported by this support and resistance. Okay, this support and resistance analysis. Alrighty? So that's what I want to say about that. And yes, if you look at the day trading course, there's about 50 or 60 hours of discussion about how to manage some of that stuff intraday. Okay. Next up, sector health and selection. The calculation of strength and consistency, and then looking at several different elements, like the calculation of strength and consistency for the ETF regional report and the world market model and the ETF 30, and then the world market model strength rating. Which ETFs, Jake asked, am I using to calculate? It's not 13 and 26. It is, oh no, I guess it is. You're right. Yeah, it is 13 and 26. It's 3-month and 6-month lookbacks. And yes, we're using iShares ETFs. So these are the elements here, the specific symbols that I use in that world market model. So let me pull that over so you can just, the little piece of Excel wonkery here, right? So this is the spreadsheet that I use, the ETF2 model that computes this the world market model that you see here. That's the world market model. So when I am looking at this first column here is DIA. So that's DIA. the formula is it's looking in C11. So DIA is the symbol that I use for U.S. large cap value. And the number that it's looking for, it's using this formula VLOOKUP into the ETF database summary table, looking for the third column offset, and it's using the symbol DIA. So all that gobbledygook just means that it comes over to the summary table, looks for DIA, and then finds the third offset table, 1, 2, 3. This number 60, this number 60 is under the strength, which itself is a lookup table. It looks somewhere else too, but in general you can see how this is sorted out. These are all the symbols then that are used to fill in the gaps on the world market model, and then also on these various indexes. I look at subsets and other selections. I have not gone to this as much lately. I'm using more of the BMR, but the same principle applied. So I am using this column of ETFs. These are all iShares ETFs. Martin, ask that question again. I'm not sure I understand. Would I reduce R? You talking about if I'm adding second positions? Do I understand that question right? Yeah. Yeah, that's another way you can do it. I can reduce my execution R. So if the first one, I might be willing to tolerate a 50-cent move against me. If I put that second position on, maybe I only tolerate a 25-cent move against me. So it still feels like I lost 50 cents and the dollar value is lost, but I got a double scoop on. So I don't like losing more on a secondary position than I did on the first one. So I'm pretty risk averse in that way. So that's how that spreadsheet generally works. To get back to Jake's, and then this is just a summary of those ETFs by each of those commodities and areas. Okay. So the next question was how to compute those three columns, and it's really strength, consistency, and quality. Okay, so if we looked over at the summary table, there's the strength column, there's the consistency column, and there's the quality column. Each one of these is scored on the basis of 0 to 100, and it's considered against about 500 symbols in that ETF database. And so the strength is really the blended monthly rebalancing strength. Even though it's ETF2, this strength column is a blend of 70% of the 3-month and 30% of the 6-month look back. And so way over here on the strength and consistency, what this one does is it computes 13 and 26 weeks. That's essentially 3 months and 6 months, right? And the consistency column is looking at the 10-week rolling average. So I have to actually compute 10 weekly lookbacks of the 13 and the 35. And so this spreadsheet simply is blending 30% of the 26 and 70% of the 13 week is summed and brought over here. So 0.7 times minus 3.26 plus 0.3 times 1.17 comes up to a minus 2.09. That's what the blended score for this symbol was 10 weeks ago, 9, 8, 7, 6, 5. This column then takes everything that's in the database and scores the highest as 100, the lowest as a 0, and then scores these proportionally on the basis of this relative performance scale. And then the standard deviation is what allows me to compute the red, the white, the yellow, and the green, the plus or minus 1 standard deviation. So that's how the strength is based strictly off the first week. The consistency is based off of a blended 10-week, and these are the weights. This is slightly weighted towards this week and the previous week are weighted double, and the 9 and 10 week ago are rated 1, and you can see there's a slight weighting scale. So this is a weighted 10-week moving average, and then just math is performed, and that comes up with the scores that you see reported in the strength and in the consistency rating. And this tells you what the standard deviations were, and then what the threshold for plus or minus 1 standard deviation are. A lot of math here. Now the quality is nothing more than, we're looking back 40 weeks, and for each of those 40 weeks, computing a weekly return. And then for that set of 40 weekly returns, I compute the average, and then the standard deviation, and then this comes up with this allows us to compute a standard a system quality number. You take the average divided by the standard deviation, it gives you a raw system quality number, and that gets scored from 100. The best one in here is 3.46. The worst one is minus 4.78. Then this allows us to scale the minus 4.78 is 0. The best one is 100, and then proportionally marked off, and then the score on the quality number is based on a proportional rating from 0 to 100. When all that stuff is done, we take these three numbers here, strength, consistency, and quality, all scored 0 to 100. We take the straight average, and then that gives you a blended average, which then is also color coordinated based on the best, the worst, the standard deviation, and so forth. And that's where these color codes come from. So that's just a little bit of fun with numbers using indexes and relative performance that combines three elements of momentum. The first one is the straight momentum using that 3 and 6 month look back. Intermediate term momentum, that's what that is. And then a rolling 10-week weighted average so that we get some kind of blended momentum and consistency. That's the one that's the most important to me, by the way. And then quality, which is that system quality number, which gives us kind of a risk-adjusted, longer-term look back. It is usually strength that changes first, color, and then consistency, and then finally quality. That's how those normally score. That's what I want to say about that one. Okay, so that spreadsheet is available in the Spreadsheets project if you want to fiddle around with that. So this summary here, strength, consistency, and quality, summarizes what I just said. Strength. It's computed by the blended monthly rebalancing calculation, which is 30% of the 6 month and 70% of the 3 month, which is then indexed by ranking all the elements in the database 0 to 100. Consistency is the weighted average, 10-week weighted average, also scored 0 to 100. Quality, a 40-week system quality number, then scaled 0 to 100. And you'll notice that the ETF2 strength rating is exactly the same as the blended monthly rebalancing strength. That works across two different systems. Okay. Next question. BMR reports, ETF regional and world market model, and then the SwingZ. Are all three of these viewing performances of various sectors through a different lens? Yes, they are, because I don't like to get locked into a single view of the market. I like to see triangulation. They really do measure different things. Yeah, it's all price action over time, but they are sufficiently divergent in their computation that I feel like it gives me a little more confidence in the strengths of the moves that we see. So yeah, that all three systems give a little independent verification. Next question. Average volumes on ETF top 30 range from 500,000 to 30 million a day. What volume levels do I find sufficient? Well, I set the threshold at 500,000 shares a day. That's why that's the lowest number that appears in there. So when I look, I set it at 750,000. Yeah. So what I'm doing now is I'm looking at really the top 100. So if I look at, let's see, largest to smallest. The one that's in the number 100 position is at 527,000. So this is really the top 100 share, top 100 based on average volume. And if we go smallest, I think that's going to be SPY. Yeah. So the SPY, then the Qs, then IWM. And that's, so I would say really about 500,000 shares per day is the minimum that I think is liquid enough for us to be able to hide without worrying about moving the market. You want a really liquid market and narrow bid-ask spread. Okay. Now, question number 7, I'm not going to dwell on too long because a lot of this has to do with the day trading course. But because we also do core and turbo, I do want to at least answer the questions and then encourage you guys to maybe consider the day trading course. Would these be the steps about basically how I frame intraday? Frame the close with a gap stat, and if it opens outside the gap stat, it deserves special attention. I would agree with that, yes, because any gap larger than the gap stat is by definition, a large gap, and therefore we are more likely to see a large range day, and that makes it very favorable for intraday trading. So if I have a swing trade that then has a large gap, I might just start with it as a intraday trade, and then once it calms down, I may be able to find a way to trade it as a swing trade by keeping just a portion of the day trade position size. Because my stops are a lot smaller intraday, my position sizes are larger, and therefore I can sell most of the day trade position and then keep a piece overnight if it closes well in the preferred direction. So I then bracket the frame, the opening with a frog box. I actually use a frog box, a hybrid frog box at 0.7. I've made that as low as 0.5, but I'm comfortable in recommending that you consider 0.7 of a frog box for your initial bracketing. And then I can enter, I basically am using frog techniques, and you can see the day trading course for that. But yes, morning hooks or movements away from a high or low of the day, that's the frog system in a nutshell. And then finally frame the entry with the range stat. Well, yes, the entry consider, from where I'm entering it, if it's a large gap day and I can enter after a hybrid frog move, then there is at least 3-to-1, usually 4-to-1 frogs all the way to a range stat. So that tells me that that's what my reasonable intraday move can be. All of the, let's see, what criterion makes a good intraday target for me? The day trading course has a lot more information on that. It talks about the patterns of P1 through P7 in the first generation. It talks about collapsing dragons, emerging dragons, owls, P1 failures, Z3Ps, and all that jazz. But in terms of looking at the daily characteristics to see is there something about that makes it more likely to be a good intraday trade, I would say all of these except for the average volume over the last 30 days. There may be some information in there, but I don't pay attention to that volume. I look at volume at price, but I really am more concerned about the percentage movements and the daily volatility in Bollinger Bands. But all of these other ones, I would say yes. A large signal to noise ratio, especially if it's in the green, says this thing has more signal than most. That means it trends intraday and is therefore better than others. I prefer the pinch and stretch statistics. to tell me which ones are in their life cycle more likely to have larger than average moves. General knowledge, I would say yes, but general knowledge of a symbol's past intraday movement for me is precisely described by the use of all those statistics. So I would replace the word general knowledge with statistical descriptions. Yes, anytime anything is either pinched or stretched more than 2 standard deviation, it's such an extreme condition that something's going to change or there's a big move coming. In the same way that a doji is a special case of that, where it had a very tight daily range, and that quite often signals that that one-day pop kind of a move. And then any combinations of the above, yes. I would also say anything that fires on a daily chart for a swing trade, like swing signals or continuation patterns, and then really more of that information is contained inside the day trading course of what makes good intraday targets using the end of day data. But I think if you look at the Z3 pinch and stretch, the auto framer, continuation patterns, dojis, and all that, there are so many good candidates that self-nominate that you will never run out of good targets. Number 9. After trading something intraday, what behavior would keep my interest peak for the following day? Exceptional success or failure as judged by its peer group. So it went up 5% and the sector only went up 2%. That means there's a lot of buying interest in it, just in the company. It hasn't hit its swing stop yet, and I'm still in the money. Any kind of success keeps me interested because I'm already committed to the trade and I understand the information, right? Number 10, the last one. Some of the intraday targets like Wynn, Devon, and Cliff are not on the Dow 30. How am I finding these and selecting the targets? Is the frog list an extended list including other symbols? Yeah, in the frog spreadsheet, I include many more symbols. And I mean, you can let that, if you love the frog, you can make that thing 500 symbols. And really the other patterns too. I just find out if I have multiple signal generators, I don't want as many different targets. I'd like to have a dozen systems and 30 targets rather than one system and 1,000 targets. I'd like to have a little diversification in the system. But in the specific case of Wynn, Devon, and Cliff, those were all symbols that came to our attention as a result of like research weekend inquiries or guys that were mechanically trading or doing back testing on this S&P 500, and these things turned out to be frog champions or swing champions, or they were very strongly in the case of Devon, very strongly correlated to the energy sector and was very volatile and had a very large signal to noise ratio and was cheap. And so it turned out to be a very good intraday trader and a very good swing trader. And it's not a surprise that Devon and Cliff are both categories like that because they're strongly correlated to the commodities market that they are members of. That you get the swing characteristics of commodities plus their own very nice swing trading and day trading trending. So they're liquid, and so yeah. So it comes from previous ideas that we looked at and then discovered, yeah, that could be traded. And I think of those as specials. I generate fewer specials these days as I get more comfortable with my favored patterns. But one of the ways you can develop specials is if you concentrate on a couple patterns and you want to get enough signals so you broaden your look out to maybe the S&P 100 or the S&P 500 or companies that you're already knowledgeable of and which are representative of certain business sectors, that you can use these techniques on targets of interest. What makes something tradable as a swing or as an intraday is that you have enough volume, you have directional, reliable movement, larger than average, and it has a high signal to noise ratio on whatever time frame you're looking at, and it outperforms the sector. That means that there are people that are aggressively buying it and not just buying the sector, and it passes information to that target. So that's everything that I wanted to say about that one, and I encourage you to consider the day trading course once you get through with the swing, and there we are. So last chance, fellas. If no further questions, I will get this recording processed and posted and I'll have it posted on this page later tonight. This will be a link. This will become an active link right there. And the weekend report review was already posted on the channel. And there's some. It looks like energies, financial, and the market is in this very critical state in either direction. So I'm expecting some good trading this weekend. Okay. Thanks a lot, guys. Take good care, and we will see you in the chat room.